One important aspect in preparing this book was for us to include also unrealistic fundamental reform proposals. We believe that even though they might not be adopted, understanding them is crucial for understanding also the aspects reflected later in the compromise solutions.
The book is aimed at tax policymakers, but also at other analysts and students of the international tax architecture, as well as all those who are interested in where we've been and where we might go.
This book takes a step back and asks, why do we need reform? What are the underlying objectives? And how can reforms bring us closer to a solution to these problems?
Good morning or good evening, as the case may be. Welcome to this book launch. Today, I have three different books on tax on my mind. The first, Taxing Profits in the Global Economy by Michael Devereux, Alan Auerbach, who is with us today, Mick Keane and others, complements nicely the book that we'll be launching today and that you have seen summarized in the film. The second, Rebellion, Rascals and Revenue by Mick Keane, again, and Joel Slamrod, compiles amazing and funny stories about taxation since the beginning of civilization. They explain that the first step in understanding the international tax system comes from recognizing that it is no tax system at all. Instead, it is the juxtaposition of national laws and a web of about 3,000 bilateral tax treaties. The first treaty dealing with tax income matters was agreed between the Imperial Germany and the Austro-Hungarian Empire. Keane and Slamrod argue that there is nothing in today's swamp of practices that would have surprised the architects of the Austro-Hungarian-German agreement reached at the end of the 19th century. But economic and financial realities have arguably changed in the last 100+ years. And reflecting on policy options for the international corporate tax system for the 21st century is the focus of the book we launched today. And there is no one better to start us off than the IMF Managing Director, Kristalina Georgieva. Up to you, Kristalina.
Thank you, Vitor, for the kind introduction. And congratulations on this great achievement to Ruud, Alex, Vicky, and all the contributors in our fiscal affairs and legal departments and beyond. Corporate income taxes under pressure. This is an illuminating, comprehensive, and timely contribution to a vital global debate, and I'm thrilled to help launch it. Taxes are as old as civilization, as are efforts to escape them. Put the tax on windows and people will bring them in. Tax imports too heavily and you get smugglers. Tax corporate income and companies will shift profit, invert, find a way to avoid paying. But well-designed taxes can minimize this behavior. As a steward of the international financial system, the IMF has long recognized our duty to promote global corporate taxation that both supports productive business and is fair to our member states. This is especially important for low-income developing countries, which often depend on corporate taxes the most. Looking back, the greatest historical driver of tax policy innovation has been war. The cost of World War I and post-war reconstruction helped create modern corporate taxation. And now we face two disastrous and very expensive crises of COVID and climate change. These urgent needs, combined with a renewed spirit of multilateralism, give us a unique opportunity to rethink and fix the international tax system, to create a system that is truly fit for the 21st century. Here, the IMF fully supports the OECD's inclusive framework on base erosion and profit shifting. It involves 139 economies that offers a chance to head off conflicting actions among these countries. And as Secretary Yellen stepped in, she energized the international tax reform conversation last month by announcing a push with G20 nations for a global minimum corporate tax rate. This type of multilateral approach is the only way to ensure that highly profitable multinational firms both pay sufficient tax and pay it to countries where they have significant engagement, including in low-income developing countries. We are particularly optimistic for a global agreement on corporate income tax in 2021, this year. And it is urgently needed to avoid down the road the risk of spiraling into a chaotic tax or trade war where everyone loses. This new book discusses proposals for a global minimum tax, among many other topics. We offer it to those directly involved in the reform debate and all who are interested, to help them focus on and address the fundamental questions. What is wrong with the current system and why? What principles should guide a future-looking system? Given the extreme complexity and difficulty of designing efficient taxes, how do we turn these principles into practical solutions? One thing I love about IMF economists is that they are dedicated to helping our members make policies that work in real world. For instance, how should we treat the globe-spanning digitalized companies that are among the most valuable and profitable in the world? Many of them have fared very well during the pandemic, doing business in nearly every country. But century-old rules give taxing rights only to countries where firms have a physical presence. The internet giants and many other firms also avoid taxes by putting valuable intangible assets in low-tax countries and shifting profits to them as well. How do we fix this without creating new problems? The book explores how companies can be partly or solely taxed where their final consumers are based, rather than only where production takes place or the company legally resides. This creates some risks, but would be fairer in a digitalized economy and reduce harmful tax competition. Another solution is a new way to allocate profits of multinationals between countries. Companies currently separate the accounts of related entities and act as if they are independent. A simpler way is to consolidate the profits of a multinational group and a proportion of profits to countries based on factors like employment, capital, or sales in each country. This would also put an end to harmful profit shifting. And these are just few of the solutions in this wonderfully useful and great to read book. Let me close by recalling the tax on windows that started in 18th century Britain. It was intended as an innovation, increasing privacy by allowing tax inspectors to do their work without entering homes. But as people bricked up windows, it became a distortion, a hated tax on light and fresh air. The international corporate tax system has become similarly dark and distorted. But we have a special opportunity this year to bring the light of simplicity and fairness to it. We must rise to the occasion. Thank you. And now over to Alex.
Thank you very much, Managing Director. Let me now get straight into the book. And for that, I will share my screen. Let me start by explaining why we prepared this book. There are different ways to approach this. One thing we are certain of is that many people are worried about the international tax system. So it's not just something for specialists. Words like paradise papers, tax wars, they have been in the mainstream press, and also calls that multinationals should pay their fair share. At the same time, there are specialists thinking about this. They might say things like, oh, let's compare the DST to amount A of Pillar 1, and that doesn't mean anything to anybody else. And we thought that in analyzing these issues, we have to bring it all together. We have to have one book that covers all the basics in a self-contained way, explains everything, but also covers the latest developments and the latest complications. So what we strive to do in this book is to answer the following questions. How does the current system work? What are its main problems? And what are the potential solutions? And in doing this, we try to always think about the developing countries and make sure that we include their specific issues. Let me stress that this book is not something we wrote just in 1 year or two. Instead, it's something that draws on many years of work at the IMF. We've had major board papers on this topic in 2014 and 19, and in between we had other board papers on related topics like debt bias or leverage. And every time we go to the board with the paper, it's not just the paper that we prepare. There's a lot of background work behind that, and much of that, which was often unpublished, has found its way into this book. As already mentioned by Vitor in his introductory remarks, also Michael Keane contributed to another international textbook together with Professor Alan Auerbach, who we will see very soon speaking here too. And then we have been drawing on many of the papers that we have produced over the years. Apart from this analytical side of the work, also our capacity development experience or our technical assistance work plays into this. So very often countries ask us for advice on how to reform their international tax systems, and the advice we provide to countries has fed into this book. And then under the surveillance, or what people who watch the IMF know as the Article 4 consultations, we have a special program to look at international tax issues, and we have so far implemented this in 27 countries. Let me now jump right into the book. The first question we addressed is, why should we tax corporate income? And while this is not a new question, it's absolutely essential, because if the answer were no, we wouldn't need this book and we wouldn't need to worry, because it would all be moot. So the answer is, of course, yes, we should tax it, but the chapter explains in a bit more detail than what I can do now, how this can be done, what are the trade-offs, and what this really means. After that, the next chapter turns into the key concepts of the tax system. So it starts off really, really easily. It says things like active income, which means the income from doing business is taxed at source, while passive income is taxed in the country of residence. But then it quickly becomes much more complicated, because we will see that this basic rule doesn't really apply in practice. There are many rules that actually complicate this so that everything is taxed at different levels. And then the double tax treaties that Vitor mentioned in his remarks in the beginning, they also make it more complicated, and they can be different across any pair of countries. But the real difficulty for multinational enterprises is that for tax purposes, we have to pretend that they are not multinational enterprises. We have to pretend that they are separate enterprises in each country and somehow split their profits. And we do this by forcing them to calculate their export and import prices as if they were independent firms and not part of one global group. And that theme will come up a couple of times here. So why is the system that I've just described a problem? I've already alluded to it, and the managing director has too. But the underlying reason is that this was established in the 1920s. And when it was established, it actually was fit for purpose. Because in the 1920s, it was not very difficult to think about a corporate residence. Owners and managers of a company, they were well known. They were usually in the same country. They had an address, and there was little doubt about it. If you wanted to know the source of income, you could just look where the factories were and the workers, and there you had it. If you needed to determine transfer prices, first of all, it didn't occur very often because most trade was in finished goods between unrelated parties. But even if occasionally you had to do it, it was mostly tangible goods, often raw materials. So the occasional transaction might have been difficult. Overall, it was not difficult to figure out profits country by country. But what happened, and this is described in the next chapter, is the rise of the multinational firm, or really now the global firm. These are firms operating in many countries of the world with very complex global value chains, meaning they produce in more than one country and they trade intermediate goods. And these goods are unique. They are unique to one particular firm, so you cannot find comparable goods in the market. They are heavily reliant on intangible assets, which are difficult to value, and the return on those assets is also difficult to determine. Their residence, while we can legally possibly define it in some cases, economically it makes little sense, and it is easy for them also to change it, taking advantage of the legal provisions and of the often different legal provisions across countries. So then, if you think of such a global firm, allocating profits to a specific country is really difficult, not only practically, but even conceptually. So profit is actually not a category that is linked to a geographic location. Unlike the weather, profit is just a number. It's global sales minus global costs. And this leads to problems. As the managing director mentioned, there is profit shifting and tax competition. Profit shifting is related to the difficulty of determining profits in a given location, which gives companies leeway to interpret it in the way that leaves most of the profit in low tax jurisdictions or in jurisdictions with lower taxes than others, and that reduces their tax bills. And we have some empirical evidence suggesting that this problem is actually worse in developing economies. There's a chapter that goes in quite some detail through this with the example of risk. So if you think of a global firm, we all understand such a global firm can face risks, but how do you allocate the risk to each of the individual affiliates? Now, lawyers can of course do it. We can look at the contracts between the firms, their obligations, and so on. But this is all still the same firm, so they can write it any way they like. And another thing for those of us who remember their statistics classes, if you add up the risks of each of these individual firms, the aggregate risk is not the sum of them, because you have to take out the covariance. So even if you did this properly form by form, you will run into problems. Tax competition is the second big problem. Countries have an incentive to reduce their tax rates to attract capital, or alternatively, they introduce special regimes. And we certainly have seen tax rates coming down, as you see in the chart. Now, very recently, I've heard of some countries raising their corporate tax rate. So maybe that part of the book will at some point be outdated, but I'd actually be quite happy with that. It would not be a problem for us. We also have a chapter that compares profit shifting, allowing profit shifting with these special regimes, because it's actually quite similar. Instead of having a special regime, you can tolerate profit shifting and become more attractive. So having discussed the problems of source-based taxation, would it be easier to solve it by focusing on residence-based taxation? That's what is looked at in the next chapter. And the answer is that residence-based taxation also faces its problems. So first, it's very difficult to define corporate residence. Again, legally, we can do it. We can set some rule, like where it's incorporated or where the management resides or something like that. But practically, all of these things can be manipulated. and it's not really deeply meaningful in the current world. Moreover, countries can compete over corporate tax headquarters to become really attractive places for multinationals to locate their headquarters. The next chapter then looks at tax treaties. Tax treaties are often known as double tax agreements. Now, everybody thinks double taxation must be bad, so a double tax agreement resolves it when we have only one level of tax, and that's fantastic. But what this chapter shows is that very often it can actually lead to no taxation at all, or very low taxation. These treaties are often used to erode or risk eroding revenues, and this is especially a problem for developing countries. The following chapter then turns to digitalization. Digitalization, first and foremost, exacerbates the problems that already exist. So everything I have described so far becomes kind of worse with digitalization, because digital firms, they have even more intangible assets than other firms. And they can operate across borders without a physical presence. So not only is this not in line with the current definition of a taxing right, but also it's practically just difficult to notice that such multinational is operating inside some jurisdiction's border. But there's also a newer factor to this, and this is the contribution of personal data to profits. So if a digital firm collects data in some country, but doesn't have any transactions there, should they be paying taxes in that country? We can approach this question from the production side. You could argue that by providing data, people also contribute to value creation, and therefore, based on the source principle, we should tax it. Or you could approach it from the destination side and say, well, these people who provide the data, they're clearly consumers, and then based on some destination approach, we should tax them. Interestingly, it depends a lot on how you would implement such taxation. And as this chart shows, depending on how it's done, the distribution across countries could be very different. After talking about all of these problems, let me now turn to the solutions. First, we have the incremental solutions, things that kind of address the problems head on in small steps. So one chapter looks at strengthening source-based taxation. So just to give one example, we can expand definition of nexus, which is again a complicated way of saying something simple, which is that instead of requiring that a company has a physical establishment, we could define connection to a country also through a digital establishment. So maybe if a company has a website from which they sell into a market, that could be enough. So this is something that's discussed in that chapter. There are also a host of anti-avoidance measures that I will not go into now, but that are discussed in that chapter too. Equally, we can do incremental reforms on the residence side. So we can tighten CFC rules that are controlled foreign company rules. These are basically rules that make sure that if you artificially have some financial operations outside the home country, that it's nevertheless included in the tax base, which makes it harder to shift profits. And we can have the minimum taxes that the managing director already mentioned in her remarks. But let me now turn to the truly fundamental reforms. One of them is destination-based taxation. So this reform would really completely do away with all the complications I've mentioned. There would be no more allocation by arm's length principle transfer prices. Instead, all exports would be exempt from the tax base, and imports would not be deductible anymore. In such a system, there would be no tax competition and no profit shifting. Why? Because you can manipulate your transfer prices as much as you like. If exports don't enter the equation, it doesn't matter what these prices are. It's also not, there will be no tax competition because the base is determined by the consumers, and the consumers are the least mobile of all the possible factors of allocation. And then because there is no tax competition, we can design such a tax in a neutral way, meaning we can have a narrower base and a higher rate. The higher rate will not matter. And that means we can implement it as a cash flow tax, which is a tax that is neutral to investment. So with such a tax, every investment that would be profitable in the absence of tax would remain profitable in the presence of tax, while investments earning high rents would face a very high tax. Now that sounds also fantastic so far, so I should also mention the challenges. One is a more legal challenge, doubts about WTO compliance. But there are other things like a refund issue. If you exempt exports, then some companies that focus on exporting, they would have a negative tax liability and would require refunds, which all evens out over time and across countries. But in any given country, at any given point, it could be a problem. And then the most important thing is really, if this is done unilaterally or without cooperation with others, it can really harm all the other countries that are not moving through this system. Finally, it doesn't really help the extractives because they have location-specific grants. The next fundamental reform proposal is formulary apportionment. The idea already mentioned by the managing director is you put all the profits together of an international firm, and then you allocate them by factors, by some formula based on factors. This has been done for decades in the US for state level taxes, but it has not been done internationally. So it's much simpler than the current system. It eliminates profit shifting, though not all type of manipulation. And it might lead to revenue gains in developing countries. Whether other countries gain and which countries gain, that depends a lot on the formula used and the factors of production, as you can see in this chart, which I don't have time to describe now. But it's very remote from current practices. In the EU, it has been tried to introduce such a tax for also decades now, and it has never gone anywhere. It requires a tremendous amount of coordination, which is difficult to achieve internationally. The next topic would be residual profit allocation, which is a subset of formulary apportionment. It's in a way similar, but closer to the current system, because the routine profits, or what economists would think of as normal profits, would be allocated through the source countries as it is now, and only the residual or supernormal profits would be allocated by formulas. So this is kind of similar to formulary apportionment, but maybe because it's less removed from the current system, easier to introduce, but then it also has fewer simplicity gains. I should also mention that the book goes into a couple of special aspects, which developing countries is treated separately. And then in cooperation with our colleagues from the legal department, there's a whole chapter on tax law design issues that covers the legal side of these reforms. And with that, let me come to the conclusions. So as I said, the current tax system, it made sense at its inception. It was not made by people who didn't know what they were doing. It was made by people living in a different time. The problems have been well recognized, and they are getting worse as a result of digitalization. But there are solutions. There are incremental solutions, some of them well on their way. They often reduce the scope for profit shifting. They less often address tax competition, and they sometimes even make it worse. There are fundamental solutions too, and while they're not realistic at the moment, thinking about them really helps us think about the components of the current proposals and why and how they help. And last but absolutely not least, let me stress that most reforms would benefit from international cooperation, and for some of them, it would not only be a benefit, but it would be absolutely essential. And with that, I conclude and pass on to Professor Alan Auerbach.
Thank you very much. Let me share my screen. Okay. Well, Alex gave a very good summary of the massive undertaking that he, Ruud, Vicky, and their collaborators have produced. And having gone through a similar process myself recently in the book that has been mentioned, I really appreciate how much work this and thinking this required. It's a really wonderful book, very comprehensive, and notwithstanding the book that I worked on, I think it provides a much richer, deeper, fuller treatment of the issues than we were able or attempting to do. So just to summarize again, what's in the book and the logical order in which it proceeds, which is indeed very logical. It starts by asking how we do tax, or what methods we use to try to tax corporations. What are the problems associated with these approaches? Because of the economic changes and the rise of multinationals, how might we fix these existing approaches of basing taxation on residence and source? What other approaches might be taken, in particular associated with destination, either comprehensive or incremental? How to deal with the special problems of the digital economy, something that economists don't often think of, but is obviously of crucial importance, is how we get there in terms of treaties and international cooperation. And then a special focus on emerging economies. It's not a separate part of the book, but it's sort of an issue that is dealt with throughout, and obviously, particularly from the IMF's perspective, a very important topic to be thinking about. So to motivate my comments, I like to start with and to sort of emphasize how the economy has changed over the years to make the international tax system more problematic. To think about what the US corporate sector looked like in 50 years ago and what it looks like today. In 1971, the top 5 companies, US companies, as measured by market valuation, were IBM, General Motors, AT&T, ExxonMobil. Actually, then it was Esso, before it became Exxon and before it merged with Mobil, and Eastman Kodak. Now, these are all companies that were very much associated with the US. They were companies that made things, even AT&T, because it wasn't the AT&T of today, it was the Ma Bell of the pre-breakup days that not only sold telephone services, but also sold you rented you telephones provided by Western Electric. They all made things. They were all identifiable as U.S. companies. Where they were producing was pretty easy to identify. In some cases, as with Eastman Kodak, they were making things that don't exist anymore. And now to 2021, we see 5 very familiar companies. Apple, and of course, from year to year, they fluctuate in terms of which has the highest market valuation or where they rank in this list. But these 5 companies are well known to us to be high in market value: Apple, Microsoft, Amazon, Alphabet, which is Google's parent, and Facebook. Well, these are all information/technology/intellectual property companies, and they're making things across the world. The important factor of production, intellectual property, is amorphous, and while important, it's hard to identify its location. Let's think about what the implications of this change in the corporate sector, from the companies making things in particular places that were identifiable as American companies, the companies with multinational companies with global supply chains, with international shareholder bases, using intangible capital. Well, it's put pressure on all elements of existing tax systems because of higher capital mobility. It's a lot easier to locate intellectual property in a low tax country than it is to move your factory to a low tax country. Not only because of the difficulty of undertaking the investment, but because of the complementary inputs required, like skilled labor force. It's made profit shifting very much easier because it's very hard to, with internal transfer pricing, it's made it much more difficult to figure out where profits are actually being generated. It's led to a rise in corporate inversions, at least in countries like the US until recently, that relied on residence-based taxation. And it's heightened international competition because all of the other factors which have made tax bases more mobile have led countries to compete by trying to make themselves more attractive with lower tax rates. Now, before thinking about what the solutions to these problems are, it's useful to think about what the different rationales are for corporate taxation. It's sometimes in policy debates, it goes without saying that we should have a corporate tax. But as Alex intimated, one needs to think about why we're having a corporate tax. And there are many coherent explanations, historically anyway, including acting as a backstop for individual taxation, so that if shareholders aren't facing taxes for some reason, corporations pay them. Imposing a tax on rents that are generated by a large corporation. We tend not to talk about the third one, but it's certainly something that motivates countries, shifting tax burdens to foreigners. That is, if to the extent that the corporation isn't just a national entity, but is connected to other countries, perhaps by taxing corporations, we can make some of the foreigners bear taxes, and that's always a politically easy choice to make. And particularly in the developing country context, they may simply be easier to implement and enforce. That is, there might not be any intrinsic benefit to corporate taxation, but as, in a sense, collection agents, so the corporations may be much better suited, particularly in countries with limited government infrastructure. Now, each of these motivations makes some sense, but each has its own challenges. And that dictates different possible reform approaches. So, for example, the argument for using the corporate tax to backstop individual taxation probably makes a lot less sense than it did when it was first made. It seems to call for a residence-based approach. That is, if we can't tax American shareholders, we can tax American corporations. Well, that is really ill-suited for the purpose at present, given how international the shareholder bases are in companies. That is, taxable US investors hold a small share of US corporates' equity. And so thinking that we're imposing a proxy tax by taxing US corporations is not really very accurate. Imposing a tax on rents. Well, if we want to impose a tax on rents, that suggests that we should have a tax system such as a cash flow tax that Alex talked about, or even one that exempts a normal return to capital, such as the US GILTI provision, which was introduced in 2017 as a minimum tax on earnings abroad. It exempts a 10% rate of return on tangible assets held abroad as a way of saying, look, we're only trying to tax rents, we're not trying to tax these normal returns to capital. But it still must be determined where the rents are located. For example, a destination-based cash flow tax focuses on the location of consumers. The GILTI provision focuses on the location of production, of source. And to the extent that rents are mobile, trying to tax based on source or residence as opposed to on destination may not work very well, even if you're only taxing rents. Shifting the tax burden to foreigners. Well, that's traditionally been an argument for territorial taxation. You know, if foreigners invest in my country and I impose a territorial tax, then that corporate tax, to the extent that it's paid by foreign corporations with foreign shareholders, may arguably fall on them. And that argument has always been limited by a country's size and market power. There's a very simple theoretical proposition in economics that says that for small countries, the optimal territorial tax is zero, because they can't really shift the burden to foreigners if they're small. Nevertheless, countries may think they can and still want to have territorial taxation. I think it's also, one has to be blunt, a motivation for the digital services taxes that have been adopted around the world, or are in the process of being adopted, at least if they're not superseded by some other reform. After all, it's no coincidence that the companies that are typically subject to the digital service taxes are not domestic companies, but US companies. And it's not a surprise that the US has not adopted a digital service tax, because it is less excited about taxing US companies with that approach than tax authorities and legislatures in other countries. Let me turn now to talk about destination-based taxation, which Alex kindly talked about some of the ideas that we came up in our book. But let me just illustrate what I see as some of the benefits. Now, there is, this idea has crept into other discussions. And for example, the OECD current project, which has two pillars of tax reform. Pillar one involves some sort of allocation of profit based on the market, where the market is, where users or consumers are. I think that the logic of this discussion often has to do with where value is being created, and somehow trying to come up with a contorted explanation of how value is being created by consumers, and therefore some of the right to tax should be allocated to market countries. I don't worry too much about that argument. I find it a little bit esoteric, and I'm not sure it really makes a lot of sense. I think and I share this with the co-authors of my book. I think it's just a matter of expediency. That is, it's easier to tax based on destination because consumers are much less mobile than intellectual property or other factors of production. So that's why moving to destination-based tax, a tax depending on the kind of tax you adopt, can reduce or eliminate opportunities for profit shifting, shift in residence or production, and also along the way providing straightforward answers to the taxation of digital services. Now, we recognized in our book, and Alex discussed this, that one can try to go big or take a more incremental approach. We laid out two detailed proposals: a residual profit allocation by income, a residual apportionment system, or a destination-based cash flow tax. Now, the residual apportionment approach has the advantage of building on the current system and only trying to impose an apportionment, a sales-based apportionment of the hard-to-locate, hard-to-tax intangible profits that exceed normal returns. And one of the arguments for an approach like this is that it's been tried. The US states have had apportionment systems for a long time, have been moving toward sales-based apportionment because of the obvious advantages of apportioning based on sales. So we know that an apportionment system works. It hasn't been tried at high tax rates at the international level, but certainly seems like it's a functional system, particularly if we only try to impose it on residual profits. Now, one of the drawbacks seen in the destination-based tax system, at least when it was considered by the US in the period leading up to the 2017 US tax reform, was that it really was a change from the current system. And there was a lot of uncertainty associated with it as a result of that. I think one of the arguments that was missed then was that the destination-based cash flow tax could be seen as building on an existing approach. As we discussed in the book, you can think of a destination-based cash flow tax as being equivalent to imposing a value-added tax and having a payroll subsidy. And what that means is that if you have a VAT in place and you have payroll taxes in place, you can move in the direction of destination-based cash flow taxation simply by raising your VAT rate and lowering payroll taxes. And you don't have to go all the way. It also could be adopted as an add-on or a minimum tax. And indeed, if you look at what the US 2017 tax reform actually did, it has provisions that, while not referring to the destination-based cash flow tax, have in common the border adjustments that were part of it. The US has two provisions, a foreign-derived intangible income provision, which provides a lower tax on exports, and the base erosion and anti-abuse provision, the BEAT provision, which puts denies a deduction for related party imports under a minimum tax type regime. So in a sense, we've already been dipping our toe in the water as far as the destination-based cash flow tax works, although we have a long way to go if we're actually going to get to that kind of system. I think that the issue of cooperation is very important here. And I think it's important to say that a benefit of destination-based taxes, particularly of the DBCFT, is that although coordination would make the transition to such a system less disruptive internationally, it is in the interest of any particular country to move in that direction, even if other countries don't, and perhaps even more so if other countries don't. And it's also in the interest of countries that haven't moved to move in that direction once leader countries start moving in that direction. That is, there's as opposed to the current system where cooperation is very hard to generate, this is a system that promotes cooperation because it's in the national interest of different countries to move in that direction. Coordination makes it, as I say, less disruptive, but that doesn't mean that we shouldn't look for systems that have this incentive compatibility, that is, that make individual countries want to move in this direction. And I think another argument for destination-based taxes is that if we look ahead and think about the evolving economy, continuing to try to rely on residence and source as a basis of taxation is, not to be too fine a point on it, I think it's a fool's errand. Not because whatever solutions we come up with today, which may make the systems work better today, will face additional challenges in the future as we move farther and farther away from an economic reality where residence or the source of production and profits is well defined. So with that, I'll once again laud the many authors of this excellent book for the work that they've done, which will be a benefit to many readers. Thank you.
Thank you, Al. Thank you very much, Alan, for that. It's now actually going to be my pleasure to speak with some of the many authors of the book so that they can explain a little bit about, in more detail, about the sections that they wrote. We don't have all the authors with us today, but we do have a number of them. And I will be speaking about current problems, the first part of the book, with Christoph Wurzigers from our legal department, and also then with Shafiq Habbouz, Sebastian Leduc, and Alpa Shah, who are all members of the Fiscal Affairs Department's Tax Policy Division. So I'm going to turn first to Christoph. Christoph, you write in your chapter on legal issues how the complexity of the current international system has led to the proliferation of tax avoidance possibilities. And that's been followed by complicated anti-avoidance rules, and then those have been followed by yet more avoidance schemes. How, if at all, have the measures taken in recent years helped to solve those problems?
Thank you, Vicky. Yes. Our chapter argues that the international corporate tax system has actually become more complex in response to the 2015 BEPS action plan. So the action plan addressed some of the, I would say, most egregious forms of international tax avoidance, such as treaty shopping, for instance. But this has also made the current system more complex. And this is because anti-avoidance rules, such as the principal purpose test, inevitably introduce a level of subjectivity in the operation of the rules, which then makes their application more uncertain for both taxpayers and tax administrations. As well as these anti-avoidance rules, the action plan has in fact left the basic infrastructure of the international tax system intact. And this has then led to individual countries to take additional measures that, while one could argue are broadly consistent with the desire to address profit shifting and base erosion, actually go beyond the agreed BEPS standards. And so some of these measures are also based on anti-avoidance principles, such as the UK diverted profits tax, for instance, or the Australian multinational anti-avoidance law. Other countries still, or sometimes the same countries, have also introduced or are thinking about introducing new tax instruments that are designed to operate alongside existing taxes, such as digital services taxes, also mentioned by previous speakers. So the uncoordinated nature of these taxes make the international landscape even more complex to navigate for businesses and policymakers.
So are these issues different? Are they worse, better for low-income countries that may have constraints on the capacity and just the manpower, the person power in their tax administrations? What can be done about that? Yeah,
so developing countries in essence face very similar issues, but they're more severely impacted by them. And this is mainly because, as already mentioned also by the managing director, their tax systems often more heavily rely on corporate income taxes. And developing countries also often face pressing capacity constraints, as Alan, I think, also mentioned. So finally, developed countries also are often source countries, and source countries are or have been traditionally more exposed to base erosion and profit shifting, as well as tax competition. So for all these reasons, developing countries are both more exposed and more vulnerable to tax avoidance. So this generally points to solutions that are both simpler in design and focused on preserving source country taxing rights, such as in the form of minimum tax, for instance. So developing countries often also host location-specific rents, also a point that was raised by both Alex and by Alan, such as natural resources, the prime example. But our chapter also advances arguments in support of a more expansive view of what location-specific rents might mean, and also includes a sample legal provision for location countries to tax such rents more specifically. So later in the interview, Corey, my co-author of the chapter, will expand on some of those legal complexities to implement the global reform proposals that are currently being discussed.
Thanks, Christoph. Now, I want to turn to Shafiq, who was an author of the chapter on tax competition that Alex referred to. And Shafiq, let me ask you, has tax competition across countries increased in recent decades or years? And when we say tax competition, what are they competing for? And how does that competition manifest itself?
Countries compete over productive capital and paper profits. They use tax rates and they use preferential tax regimes that provide lower taxes on specific type of incomes, such as income from intellectual properties, know-how assets, and so on. So these are, for example, the IP box regimes. Tax competitions has intensified in the last decades, as reflected in a decline in the trend of the corporate income tax rate and the increase in the number of countries that adopt IP box regimes, for example. In a recent development, however, the United States and the UK have announced a plan of possibly increasing their tax rate that could stop or even reverse the downward trend.
People, if we read, even reading the papers, we see that sometimes the distinctions drawn between harmful and, by implication, non-harmful tax competition. What basis is that made on, and does that such a distinction make any sense to you economically?
So the deep concern is spillovers from a country's tax action on other countries' tax bases and on other countries' tax rate. So that would be the strategic interaction in setting the tax rate. Harmful is a normative expression. So it requires assessing these spillovers and comparing them in different situations. There are some definitions out there. They have been adapted from a practical standpoint, but these definitions tend to focus on restraining the design of preferential tax regimes insofar they facilitate profit shifting. So it's questionable whether these definitions or some of them can capture situations of large spillovers. To give you a specific example, let's consider two scenarios, one with a zero tax rate and one where we have, say, a 40% tax rate combined with a preferential regime, say of 20%. So 0 versus 20 and 40%. Which situations generate larger spillovers? Economics suggests the situation where we have a zero tax rate or a very low uniform tax rate generate larger spillovers than a situation with an overall higher rates and revenues despite the presence of preferential regimes. So the punchline is singling out forms of preferential regimes that facilitate profit shifting per se does not address tax competition, and some would argue it even may intensify. To address tax competitions, we need broader tax reform, such as minimum taxes and destination-based taxation. Thank you, Vicky.
Thanks a lot. That was a very clear explanation of a very complicated topic. And I commend the chapter of the book to everybody who's watching. Sebastian, you wrote about tax treaties, and especially with regard to developing countries. What are some of the key challenges that developing countries face in relation to their bilateral tax treaties? Over to you, Sebastian.
Thanks, Vicky. Well, I think one worth highlighting here is really the asymmetrical nature of the relationships in which developing countries are engaged. So, for example, when we look at bilateral treaties of developing countries, we find that about 9 in 10 of those treaties are concluded with countries in higher income groups. And most often, these tend to be high income countries. One of the implications here, of course, is that capital flows will, for the most part, be unidirectional. So when you look at FDI data, for example, you can see that the economic relationship will tend to be such that you have a clear capital exporter on the one hand and a capital importer on the other, with the developing country, of course, being the capital importer. So what does this mean for treaties? Well, I think this makes the balance between source and residence taxation even more significant, even more pronounced for them. It implies that restrictions placed on source taxation through withholding taxes, for example, will in practice be borne overwhelmingly, if not exclusively, by a developing country, hence the asymmetrical nature. And perhaps one other that I would highlight today is again the asymmetry, but this time in terms of the capacity levels of the different negotiating teams. From my experience, developing countries have little expertise, say, in tax treaties, and just like in understanding the functioning and the basic provisions of the OECD and the UN model, for example. This, of course, places them at a disadvantage when sitting across the table are well-seasoned negotiators from developed countries. When across the table are well-seasoned negotiators from high-income countries who really do specialize in tax treaties. So there's a risk here, that developing countries will not fully appreciate what is being agreed to, or at least, be in a position of duly weighting the pros and cons of different provisions and of the tax treaty as a whole.
Bottom line, does that mean that developing countries should avoid tax treaties, should avoid entering them?
Right.
Is that what your chapter concludes?
Well, I think the empirical evidence so far, and there's been a lot of research done on this, fails to demonstrate a clear, or I would say unambiguous, causal relationship between treaties and foreign investment. So if the objective is to attract investment, there may be better ways of achieving this, including, by introducing tax incentives in domestic law along the lines, of those that were prescribed by the 2015 toolkit from the platform on tax incentives. But that being said, and perhaps taking a more pragmatic view, tax treaties have been around for a very long time and are likely here to stay. So from this perspective, what I would say is that I think what is most important for developing countries, well, first would be to develop capacity and expertise in the area. Second, it would be to review their existing treaty network, to identify those treaties which may be the most unbalanced, or which may lead to what I would say is, high net revenue losses. And third, well, it would be to negotiate those treaties. And I think these steps should certainly precede any new treaty negotiations.
Thanks. So now I want to turn to Alpa last in this little section. Alpa, you wrote about taxing the digital economy. What does that mean, and why is that different from the regular economy? And then maybe just to conclude, how do the main policy proposals that are now circulating relate to this distinction or approach this issue?
Great. Thanks, Vicky. So it's true that we see a handful of very profitable multinationals at the frontier of digitalization, and these are the companies which have captured the attention of policymakers in this tax debate. More generally, though, we'd say it's hard to really differentiate a digital economy. The whole economy and almost every company is digital to some degree. And so when we're thinking about taxing the digital economy rather than specific companies, really we want to identify particular characteristics of digitalization which are creating issues for tax policy around which we can anchor reforms. And these issues are, one, those of increasing sales without physical presence; two, the heavy use of intangible assets; and then three, the characteristic which we focus on in the chapter is this issue of user value creation. So this idea that users of digital services are inadvertently contributing to the profits of companies through the provision of data, but without any tax being paid in these countries, and raising issues of fairness of distribution of revenue. So to bring it back to your first question, all of these characteristics are relevant across the whole economy to varying degrees as the whole economy digitalizes. Now, on the second question about different policy proposals, first, there is the OECD Pillar 1 proposal, which in all its various incarnations is underpinned with this notion of user value. So it takes this approach of defining a certain portion of corporate profits, residual profit, and then allocating it to user jurisdictions approximated by sales. And then in the meantime, we see countries enacting digital services taxes. So these can be unilaterally imposed, and at least 30 countries around the world are working on introducing a GST, most of them taking inspiration from the EU's 2018 proposal, which is focused on taxing revenue from specific digital services estimated to have been generated by their country's users. So these are advertising services, intermediation, sale of data. And lastly, we also see a number of countries amending their PE definitions in domestic legislation to include significant digital presence. And these are triggered when MNEs exceed certain sales and user thresholds. However, none of these countries have clearly articulated rules for revenue attribution to such PEs. And many countries will, in any case, be constrained in applying these definitions due to existing tax treaties. Thank you.
Thank you. Now I'll turn over to my co-editor, Ruud de Mooij, who's going to talk to some of the authors who wrote parts of the solutions section of the book. Ruud?
Thank you very much, Vicky. Thank you very much. So yeah, let's move to the second part of the book on how reform can be designed. So we have here with us 4 authors of that part of the book: Geerten Michielsen, again Shafique Bous, and Maria Coelho, all from the FAD's Tax Policy Division. And we also have Corey Hillier from the IMF's Legal Department. So let me start with you, Geerten. The previous discussion focused on the problems with source and residence-based taxation, and your chapter explores how source could be restored or strengthened. So what are your main findings, and how important is that for the developing countries?
Thank you, Ruud. Yes, I think it's very important because developing countries are predominantly capital import countries. And therefore, they are the location of the investment, and therefore they are the first in line to be able to tax the revenue that comes out of the investment. So therefore, it is important to look at strengthening the source concept. And in our chapter, we do that. We start looking at the permanent establishment concepts, broadening that concept. For instance, by shortening the time periods, but also introducing a digital PE, as was said before, and maybe even to add a quantitative threshold requirement to the more qualitative requirements that we currently use. We also looked at expanding withholding taxes, and that can be done by increased rates. It could also be done by additional withholding taxes on cross-border payments that are currently not subject to tax, like, for instance, insurance premiums, but also rental payments. Then finally, we try to urge in the chapter developing countries to make sure that they are capturing as much of the taxation rights on capital gains. And especially in this context, I would like to mention the indirect sales of immovable assets. Now, having said all this, we have to bear in mind that having tax treaties might hamper developing countries in this effort, because they will take back some of these broadening activities. Another area that we looked into is the allocation of the global taxable profits of multinational enterprises. And that area is basically determined by the transfer pricing concept, which is pricing of intra-group transactions with comparable transactions between independent parties, very briefly said. And the two main issues there for developing countries are, first of all, trying to find related party transactions, and second, to find the right comparables. Now, the BEPS action plan has already given us some strengthening here, because they're asking for more comprehensive documentation. But bear in mind that that comes with some additional compliance costs for the taxpayer. So therefore, we also focus in our chapter on more prescriptive approaches, like the introduction of safe harbor rules and fixed margins. And then, of course, last but certainly not least, is replacing the transfer pricing by a formulary apportionment, but that is dealt with in another chapter of the book.
Thank you, Geerten. Very interesting. So the other direction is, of course, residence-based taxation. Do you see opportunities to strengthen those principles, and how would you judge those solutions for developing countries?
Well, let me think of that. I think that the introduction of a minimum tax in residence countries on outbound investment, like for instance the US GILTI or the income inclusion rule, or even in the past the more limited CFC rules, could stop investors from asking more tax incentives that drives the tax rate in developing countries below the minimum tax. So in that sense, strengthening of the residence taxation could help developing countries. But this comes with a big caveat, because strengthening residence taxation could also come at the expense of source country taxation. And I just have to remind you of the current discussion about the rule order in Pillar 2 to understand that danger.
Okay, thank you very much, Geerten. Very interesting. Let me move to Shafiq. So your chapter, Shafiq, deals with a more fundamental departure from the current norms, namely taxation based on where the destination of goods are, so the consumer countries. Some people say we already have a VAT, and would this system not just replicate that?
So a destination-based tax can be achieved in different ways. A formulary apportionment approach can allocate taxing right to, at least in part, using sales by destinations. Here, the costs will be deducted at the consolidated level, and in that sense, they are also apportioned. Another approach would be a border adjustment, say combined with a cash flow tax, as we've seen in the presentation today. This is similar to a VAT, but combined with a wage subsidy. It is this deductibility of labor cost what makes a key difference between the destination-based taxation of business income and a VAT. So in that sense, there is a distinct rule here for the destination-based tax that could, in principle, coexist with the VAT.
All right. So we already heard Alan also talk about the destination-based cash flow tax. Do you think that this is a promising direction for reform? And also, is this primarily because of digitalization?
So on efficiency grounds, we like to combine the destination-based aspect with an efficient tax, such as a cash flow tax, in order to target only economic rents, leaving normal returns untaxed. Now, a worldwide implementation of a destination-based cash flow tax is a robust, promising tax systems, because on top of that, it gives us two desirable features. First, it resolves profit shifting because mispricing intra-group transaction does not affect the tax base. And second, it addresses tax competition because consumers are largely immobile. So where is digitalization and all that? Well, as we've seen, digitalization has intensified existing spillovers, and it triggered a debate about the allocation of taxing right. And as Alpa and others said today, in practice, that complicates the idea of identifying the location of value creation. So a destination-based cash flow tax is fit for a digital world because it allocates taxing right to destination countries, thereby acknowledging also their role in generating values, but it resolves the practicalities, problems or difficulties of identifying the location of value creation. Thank you, Ruud. I'll stop here.
Thank you. Maria, let me turn to you. So you wrote a chapter about formula apportionment as an alternative to the current system. What does your chapter conclude about that? Can it be a good alternative for separate accounting with arm's length pricing?
Yeah, so like Alex already mentioned in his presentation, in contrast to current separate accounting, formulary apportionment would first consolidate corporate profits at the group level and then allocate them among jurisdictions according to a formula involving some combination of factors capturing real activities of companies, such as the resources used and sales, with the ultimate decision on the tax rates still left to individual jurisdictions. And the first conclusion we arrived to in the chapter is that this approach could in fact simplify the current international tax system and limit opportunities for profit shifting, primarily by eliminating the complexity of determining transfer prices for tax purposes. And that would be a major advantage, particularly for developing countries. But new complexities may then be created in turn as well, regarding, for example, which entities and activities should be consolidated, how to distinguish between different sectoral regimes. So think of finance and extractive industries. In the case of regional adoption of formulary apportionment, such as the use to CCTB, you still need to determine income within the so-called water's edge. So it's not without its own complexity. And the second key takeaway of the chapter for us is that formulary apportionment could also affect distribution of tax revenues. And this depends on the factors of apportionment. So for example, developing countries tend to gain the most when headcount employment receives a large weight in the formula, but they also tend to benefit on average from destination-based sales. And the last key thing that we find is that formulary apportionment could affect productive efficiency, depending again on the chosen factors of apportionment. So if you use productive factors such as assets and employment in the formula, you retain the incentive that you have currently to locate them in low tax jurisdictions, which perpetuates tax competition. On the other hand, if apportionment is done on the basis of destination-based sales, you avoid these assortive pressures, but it could encourage turning low tax investment hubs into marketing hubs. So while classic profit shifting would become de facto impossible, new opportunities for tax planning could arise related to the manipulation of these factors.
Thank you, Maria. So you mentioned that there will be impacts for different countries. Do you think that a reform in this direction would be feasible, and in what form?
Well, realistically, honestly, because formulary apportionment represents such a significant departure from the current international tax system, adopting it faces substantial obstacles, especially politically. So for example, treating multinationals as a unitary entity would allow them to offset losses globally, which would be attractive for many firms, but national governments may not find a smaller tax base that appealing. And developing countries might be especially reluctant, actually, to join a formulary apportionment union with developed countries for fear that they would have relatively little bargaining power in central decision-making. So in the medium term, at least, adoption may be more feasible only regionally among countries with similar income levels. Whereas globally, the feasibility will depend ultimately on international willingness to cooperate, of course, but also on continued pressure to reform the current system, including through partially fractional approaches, for example, under discussion by the OECD's inclusive framework nowadays.
All right, thank you, Maria. Let me finally move to Corey. So Corey, you have the chapter with Christoph, and Christoph already discussed that your chapter identifies the shortcomings of the current framework from a legal perspective. Now, looking at the current proposals in the inclusive framework, how do they reflect the issues that we have just discussed, such as source taxation, residence taxation, destination taxation, and also issues like formulary apportionment that Maria just mentioned, and tax competition?
Thanks, Ruud. Well, the current proposals in the inclusive framework are not quite as fundamental as those discussed in the book, and that's because the proposals propose to adopt large components of the current system, but with modifications. But of course, the modifications move the system in a favorable direction, and that's because they reflect departures from century-old norms. So the current proposals envisage allocating residual profits of consolidated groups by formula rather than under arm's length pricing, thereby bringing in notions of formulary apportionment that we just heard. Also, the proposals propose to give market jurisdictions greater taxing rights without the need to find a permanent establishment or physical presence. So by giving market jurisdictions greater taxing rights and allocating consolidated profits based on sales, we rebalance the system away from a source-based system towards a destination-based system. Now it does, the proposals do propose to retain large components of the current system, as I mentioned, which means the concepts of residence and source will remain relevant, as will profit shifting and tax competition that we've heard about, which is why there's the proposal as a backstop for a global minimum tax.
Thank you, Corey. So looking forward, how do you see the system evolving over, let's say, the next 10 years or so?
Yeah, well, that's a great question, Ruud. And our chapter focuses more on the legal implementations of the various reform proposals. And as you could imagine, as Maria indicated, the more fundamental the reform proposal, the longer the lead time to implement. If we just reflect again on the current proposals in the inclusive framework, which is the current system with some modifications, those modifications do represent conceptual breakthroughs that do pave the way for future reforms. So over the medium term, and let's say 10 years, we're likely to see those modifications built upon further and become more a core feature of the system. What that probably means is greater reliance on market-based taxation of consolidated profits and less reliance on backstops such as anti-avoidance rules.
Thank you so much, Corey. And let me take the opportunity to thank all the authors for their contributions to the book. I think this has been very interesting. And with that, I turn back to Vitor for his closing.
Thanks a lot, Ruud. To conclude, I want to thank Kristalina, Georgieva, and Alan Auerbach for joining us today and participating in the proceedings at this book launch. I want to thank all the organizing team for what appeared to me as an absolutely seamless session. I want to thank the editors and the authors of the book for excellent work and for participating in this very lively session. I want also to thank Mick Keen, who is not one of the editors of this book, but is somebody who has been associated with all work on tax matters in the fund in the last decades. And last, but definitely not least, I want to thank all the 300 participants, more or less, in this session on tax. And I want to tell you all that this excellent book is available for viewing and downloading for free at the IMF website. And I'm pretty sure that after this session today, you're not going to be able to resist the temptation. Thank you so much for your interest. Bye.